Mike's first idea is the iShares Core Canadian Short-Term Bond Index. The symbol is XSB.
This is one of the OGs of ETFs in Canada. It's, basically the Canadian short-term bond indices.
What do you mean OG, sorry?
Old guard,
okay.
old daddies,
Okay.
the originals.
Okay.
The original gangster, I guess, in formal terms.
Oh, I see.
So one of the very first ETFs in Canada, and a very core position in portfolios, and it's a short-term investment grade bond portfolio. So you can see it's suffered a little bit as we've had that adjustment to interest rates. Mm-hmm. So as rates go higher, bonds go lower. But that's not where we sit today. Rates have adjusted up. So now we have this ETF, which has a much nicer running yield currently than it did before it dropped 7%. And it's investment grade. So we've got government bonds in there of Canada, provincial bonds, and then high quality investment grade bonds, from companies, the largest companies in Canada. And it distributes those interest rates. Those maturities of that sort of 3 to 5 year time frame also renew. So as rates go higher, we've got the investment in the portfolio going up in the interest rates that we're receiving. This is a way to play defense. This isn't going to make us a lot of money. What it's going to do is adjust our interest rate exposure to the current interest rates more quickly. And because it's investment grade and short-term in maturity, it adjusts quickly. And investment grade means that we're not going to be exposed to a lot of default risk. So we shouldn't have companies in this ETF that are going bankrupt or double B or double B minus credits. These are all very high quality credits. Mm-hmm. And it's just a way to play some defense. Remember, stocks and bonds are now correlated. So this portfolio of stocks and bonds used to go like this, which made the portfolio just move a little. Mm-hmm. We now have them correlated, so they're going like this together. That means investors are experiencing more risk on a day-to-day basis, so they probably should have less exposure. So let's reduce exposure to both stocks and bonds and hold a little bit of these short-term bonds to dampen that volatility and get a 3 or 4% yield while we wait for an opportunity to invest in longer-term assets at better prices.
The yield calculations can be very complex here, I know, but Bloomberg's putting the yield at 2% or maybe a bit more.
Okay, and it will rise as we go through time.
Okay. Our next one is the IMGB DBI Managed Future Strategy ETF.
Yes. So this is, the symbol is DBMF, and it trades on the New York Stock Exchange. And this is one of those managed futures portfolio managers. Mm-hmm. So they're involved in all of those markets like stocks and bonds, but on top of that, things in the currency and the commodity arenas. Mm-hmm. And what the fund targets doing is it wants to own, basically it's replicating the managed futures CTA index, the largest managers in that space. It seeks to replicate their positioning in portfolios. So that's DBMF. And again, these types of managed future strategies have provided immense amount of alpha this year. And they've delivered that alpha when it's needed most. I think that portfolio is up somewhere in the 20 to 25% range.
In the past year.
In the past year.
Yeah.
And it's US dollars, so you had a little bit of lift there. Now, prior to that, those strategies did struggle for quite some years. Okay. But we're not in that disinflationary growth environment anymore. We're in the inflation, volatility, low growth, low liquidity market. That's going to create opportunities for active fund management. DBMF does exactly that, and it seeks to do it by replicating the largest players in the market.
It's interesting. Yeah, it's up about 20%, including dividends this year.
Yeah.
Oh, sorry, over the past year. Yeah. Okay, finally, Lithium, the Horizons Global Lithium Producers, HLIT.
So we want to be, again, this is sort of like the uranium play. We want to be in the place where they're producing the lithium for use largely in cars and phones. And if we look at the sale of electric vehicles, you're looking at growth that was, from 3% of sales to 25% of sales. We've got mandates around the globe of mandatory increasing of electric vehicle production, manufacturing, and driving. So when we look at that and then we say, well, how much have we got in inventory? How much are we producing? there's just not enough. And so in order to create that demand, what happens in commodities is higher prices, they fix the problem because we go and find more resources, we dig deeper, dig wider. But in the interim, while we have a tightness of supply and dictated usage and rollout of electric vehicles across a number of jurisdictions, China probably being the largest. China's got a huge amount of adoption in this space. It's 6 times larger than the United States. So I kind of feel like we haven't seen anything yet in the price of lithium. And again, it's a component of the price of the vehicle, but commodities in general, copper would fall into this category as well. It sets up a price dynamic that's going to have disequilibrium to the upside.
Yeah, it's interesting. I mean, the Australians are now the biggest lithium producers with their hard rock mines, but certainly that market's seeing frantic investment.
Yeah.
And more talk that there was a story this week that the U.S. military is even open, I haven't been able to confirm this yet, to helping to finance Canadian mining projects.
Yeah, well, mining projects in safe jurisdictions under the rule of law, which is common to most of the Western nations, this asset is going to become a critical asset as we move forward. And then this plays into the nuclear side of it too, in that you have to produce electrons to charge this. Well, where are we going to get those electrons?
Yeah, Niall McGee, the Globe and Mail mining reporter, former BNN Bloomberger, has a story right now that a company that the U.S. government is considering funding Ontario's Ring of Fire, where chromium and nickel. So that's amazing. Considering funding, but it's quite the scramble.
And we've had pressure from the ESG side of things, constricting that investment.